Hi, Matt McAleer, Director of Equity Strategies, January 7th, 2022. I am with John Mousseau, CEO, President, Director of Fixed Income at Cumberland Advisors, and in honor of the fixed income market dictating action all week, I'm going to have the Moose open up.
Thank you, Matt. We have only one word to say this week, and that word is up. Think about this. The 5-year bond, 10-year bond, and 30-year Treasury bond, all up 25 and 20 basis points respectively. So the 5-year bond started out at a 125 and the 10-year bond started out at a 150. And by the end of the week, the 10-year bond was up to basically a 177, higher than it was last March. The 5-year bond was up to a 150. That's where the 10-year bond was at the beginning of the week. And the 30-year bond was all the way up to a 211. Where did they take their cues from? Number one, the virus out there, the Omicron virus. It'll probably gum up the supply chains a little bit more. Temporarily, that means more inflation, not less. Then you see the jobs number today. Even though the amount of jobs created, some people thought disappointing with a little under 200,000, A, it was still an increase, and B, the unemployment rate went down to 3.9%. First time it's been below 4 since the pandemic started. And if you look back to the Federal Reserve's notes from their meeting, they are now serious about tackling inflation. And they're talking about raising short-term interest rates maybe as early as March. We know that they've already cut back on their bond buying programs and tapering. That will be finished in March. And so finally, the markets are starting to take their cue and bringing interest rates higher. Are they high? Certainly not relative to inflation, but they're closing that gap between inflation and where rates are. So they're going from very negative to a little less negative. We think there's more of this to continue. It probably doesn't go at the rate that we went through this week. So it's probably, a grind higher, if you will, as we go forward. Munis pretty well behaved this week, up less than half of what the Treasury rates were, mainly no supply. That usually comes a little later in the month, and always at the beginning of the year, there's lots of demand for bonds from all the rollover of maturities and called bonds and coupon payments, and not enough supply to, satiate that.
And we'll probably have municipalities rushing to the window before rates get out of control on them. Not out of control, but higher.
That's a great point, Matt. And what happens is municipalities that have bond deals on their calendar, maybe out earlier in the quarter, after they look at a week like this with treasuries doing what they're doing, they're calling their investment bankers and saying, let's move on this a little faster. And of course, what happens then? People try to get through the door at once, and like any other revolving door, something has to give. What gives? Higher yields. We think that's in front of us, and it's a good way to get paid back for being somewhat defensive last year.
Yeah, so short duration looking like the right call right now, right, even though we had to live with that short duration through tight rates.
Right, exactly.
Good. Now listen, those higher rates have really played havoc with the growth names. We've talked about that now going on a month. We want to try to be allocated between growth and value. In some of our strategies, we are overweight growth. In those areas, there's been some drawdown. On the other side, value within some of our sectors and individual securities. What a week. You saw Berkshire Hathaway rip. JP Morgan, very strong. So trying to stay allocated between growth and value has been the rule all year. If we look at the S&P 500 growth versus S&P 500 value for 2021, virtually deadlocked. So you've been able to make money both ways. Now, the one thing I'd caution myself and caution traders and investors here, just because growth got hit hard this week doesn't mean you run out and reallocate out of growth. But what it does mean is on any kind of bounce or rebound, maybe you just shave or push some from growth into value. You want to have an allocated equity posture here going forward. In terms of what we did this week, very, very busy week. First week of the month, first week of the year, and we came out of the gates flying. Tuesday, Leo got an exit signal on the quant strategies. So clients saw quite a bit of activity there. We sold the S&P. That was from our September buy signal. That goes to cash. So you're now in treasuries within our quant strategy. What else does that do? If you recall from our previous videos, when we get an exit, it gives us a defensive posture in some of our allocation within U.S. equity and sector alpha. So our 3 aggressive sectors were sold, replaced by utilities, healthcare, and staples. They held up relatively well throughout the week. By the way, S&P down about 2.25%, 2.5% from that exit signal. So far it looks very timely. In terms of what we're looking for next week, let's see if some pressure can come off of tech. Did notice this afternoon that Microsoft hung in there very well. Even Adobe, which has been hammered mercilessly over the last month, traded on a relative strength, from a relative strength standpoint, traded better than the NASDAQ. Let's see if those strong, stalwart type of growth names can get some footing under them. On the other side, the story stocks of the NASDAQ. Again, we've been repeating this for some time now. The pressure did not come off them today. If you're not making money, if you've got to go to the market, whether it's the debt market with higher rates or the equity market where maybe you have to sell more shares because your price is lower to generate X and dilute your shareholders more, big headache. So on the growth side, where we're attracted to solid balance sheets, solid growth, not having to get to the market to fund business. Let's see what next week brings. Don't forget to like, comment, and subscribe. We'll try to answer any questions we get, either on YouTube or in our weekly video. Thanks, Moose.
Thanks, Matt.
Busy week. We'll see what next week brings.
See you next week.
Have a nice weekend.